Ever wondered how hedge funds beat the stock market? Well, let's dive right into it. Today we're venturing into the fascinating world of hedge fund strategies, and we'll start off with the first one, long-short equity. This strategy is like playing both sides of the coin, where fund managers buy undervalued stocks, expecting them to rise, while selling overvalued ones, betting on their fall. This clever play on price differences is what helps them secure steady returns. Here's a fun fact for you. Long-short equity was the original hedge fund strategy. That's right, it's the granddaddy of them all. The best return with this strategy can vary widely, but hold on to your hats, folks, because some funds have reported returns as high as 20% per year. Now that's a strategic play, isn't it? Moving on to our second strategy, we've got market neutral. Now, what does market neutral mean? It's a strategy that involves creating a portfolio of long and short positions in stocks. The aim here is to have a net market exposure of zero. That's right, zero. It's like being on a seesaw where both sides are perfectly balanced. Think of it this way. You're playing both sides of the field, betting on some stocks to go up and some to go down. The goal? To make sure that no matter which way the market swings, you stay steady. And the interesting part? This strategy is often used by those who want to avoid exposure to market volatility. It's like having an umbrella that protects you from both the scorching sun and pouring rain. And the returns? Historically, they've been around 5 to 10% per year. Not too shabby for playing it safe, right? Talk about playing it safe, huh? Next up, we've got merger arbitrage. Now this strategy is a bit like being a Wall Street fortune teller. It's all about predicting the future of two companies that are about to merge. Here's how it works. Investors buy shares in the company being acquired and simultaneously sell short the shares of the acquiring company. The real beauty of merger arbitrage is that it's like betting on a sure thing. You see, the outcome of the merger is usually known in advance, so it's like playing poker with the cards face up. And the returns? Well, they've been known to hit between 10 to 15% per year. That's no small change in the world of finance, and remember, this isn't betting on whether the market will rise or fall. It's about the outcome of specific events, in this case, mergers. Now, isn't that an interesting gamble? On to our fourth strategy, we've got global macro. Now this one's a bit of a biggie. It involves taking positions in financial derivatives based on the economic and political views of different countries. That's right, folks, we're talking global chess here. To put it simply, if a hedge fund manager believes that a certain country's economy is about to hit the high road, they might invest in that nation's currency or equity markets. Conversely, if they foresee economic turmoil, they might short sell assets linked to that country. Now here's an interesting fact for you. This is the strategy that legendary hedge fund manager George Soros used to break the Bank of England. Yep, you heard that right. And when it comes to returns, well, let's just say they can be pretty darn high. Some funds have even managed to achieve over 50% per year. Now that's a global game changer, ain't it? And finally, we've got the event-driven strategy. Now this strategy ain't for the faint-hearted, y'all. It involves taking a position in a company that is facing a major event. This could be something as monumental as a merger or as drastic as bankruptcy. Now you may be thinking, why would anyone want to jump into such a volatile situation? Well, the answer lies in the potential for high rewards. Sure, this strategy comes with a high level of risk, but the returns can be staggering. Here's a fun fact for you. Some of the most bold and daring hedge funds have used the event-driven strategy to see returns as high as 30% per year. That's right, 30%. Now that's what I call making your money work for you. Well, that's quite the thrill ride, ain't it? It's like riding a bull in a rodeo, unpredictable but exhilarating. So that, my friends, is the event-driven strategy. So there you have it, folks. 5 weird and awesome hedge fund strategies. We've journeyed through the labyrinth of hedge fund stratagems, from the balanced scales of long-short equity, where we buy undervalued stocks and sell overvalued ones, to the calm waters of market neutral, where we attempt to nullify market risk by maintaining a balance between long and short positions. Then there's the high-stakes game of merger arbitrage, where we capitalize on the price discrepancies of merging companies' stocks. The fourth strategy, global macro, calls for a wider lens, looking at global economic trends to make investment decisions. Lastly, we dove into the timely world of event-driven strategies, where we capitalize on price discrepancies that arise from corporate events. Each of these strategies has its own unique approach to navigating the turbulent waves of the stock market. They've proven their mettle, often beating the market with impressive returns. Long-short equity, for instance, has seen returns upwards of 20%, while market neutral, with its focus on risk mitigation, has consistently provided returns in the range of 8 to 10%. Merger arbitrage, despite its risks, has offered returns in the ballpark of 10 to 12%. Global macro, with its broad perspective, has given returns as high as 15%. Finally, event-driven strategies with their focus on specific corporate events have seen returns upwards of 25%. These strategies are the tools that hedge funds use to navigate the unpredictable seas of the stock market, aiming for the elusive goal of consistent, high returns. They're not for the faint of heart or the uninitiated, but for those with a taste for the game. They offer a path to potential riches. Remember, the stock market is a wild ride, but with the right strategies, you can come out on top. So keep learning, keep investing, and who knows, maybe one day you'll be the one beating the market. Until then, stay savvy, folks.